I'm going to go over how to avoid the 14 mistakes beginning and intermediate options traders make. First, I need to qualify myself. My name is Karl Domm, Karl with a K. And I've been trading options online since the mid-1990s. And since then, I have taken well over 50 online stock and options trading courses. And recently, I started reviewing them online at my YouTube channel called Real P&L. And one of my goals is to change this industry. I want to change the buying criteria when anyone wants to buy a stock or options course on YouTube. If promises are made by a YouTube instructor when selling a course, then I believe they should prove their credibility. I see only one way to prove credibility, and that is to share P&L. Not only share the P&L, but also share the account P&L volatility, which means how did the account value move up and down? If your account made a 20% return, but it was down 60% at one point, then the 20% return is not a good return on risk. Now, sharing P&L volatility is important because risk-adjusted returns are the real truth. And this is why I share my P&L and I show my daily moves of my P&L every month on my channel. When you're watching YouTube and considering an options instructor or options class to take, you often come across an ad or a video that makes claims like these. How I made $2.4 million in a month. How I made $94,000 in 45 minutes. You can make 2 to 5% returns per day. You can make $1,000 per month trading only 30 minutes a day. You can make a 100% winner in your first trade. I've mastered a trading technique that makes money and I can share it for a fee. I'm an ex-floor trader. I'm an ex-hedge fund manager. I was VP of Goldman Sachs. I'm on CNBC. I'm on Fox, Bloomberg, TD Ameritrade. I'm on Yahoo. My office is in New York. My office is in Chicago. I wear a special trading jacket, and I can show you how to make money online. If you trade like me, I'll give you capital. All you have to do is pay for my courses. I have an easy to implement formula, an obscure signal, a secret number that tells me when to enter and exit the market. I have testimonials showing people making $74,000 in just days, or $20,000 on a single strategy, or up $175,000 since I joined this class, or I've identified the next stock that will multiply in value. Or if you want to be rich and trade like the 1%, take my special offer. Or I can show you how to turn small accounts into big accounts. I started with $12,000 and now I have almost $5 million. And I make millionaire students. When you follow these people, what kind of mistakes will you make? Wait, a better question is, what kind of mistakes do these guys make themselves? I would say some of them only trade stocks, some of them are intermediate options traders, and a couple may be considered professional traders. And I'm going to talk about the mistakes that beginner to intermediate options traders make. And also be sure to be on the lookout for my next video called How to Avoid the 10 Mistakes Professional Options Traders Make. And once that video is done, I'll put a link in the description. Okay, let's get into it here. Mistake number 1. These mistakes are not in any particular order because any one of these mistakes can be detrimental to your trading account. Mistake number 1 is having too high of expectations. If you were to guess how the market, represented by the S&P 500, did over the last 10 decades, how many would you say were up decades and how many were down? Would you say 8 were up and 2 were down? 7 were up and 3 were down? No, it is 5 up and 5 down. And the average returns have been approximately 7.5% per year. And did you know that if a fund manager can outperform the S&P 500, he's considered a brilliant investor? That means he needs to only average 8% per year to be a top fund manager. Did you know that over the last 10 years, the average hedge fund made less than 6% per year? Now, as a beginning or intermediate options trader, how can you expect to outperform the professional hedge fund managers? Well, the only way to do it is to take on more risk. When you take on more risk, you're increasing your chances of becoming a losing trader. Your P&L volatility or your account value can swing drastically. You could be down 80% or up 80%. You can get into an unrecoverable situation. So mistake number 1, trading with way too high expectations. Now I'm going to go over mistake number 2. So beginner to intermediate options trader, mistake number 2 is trading low probability trades. Let me give you an example. So this is an example of a risk curve, and I go over this in detail in my book called A Portfolio for All Markets. But I'm going to go over it here, what a basic risk curve is. So if you have a position on, this happens to have a position where I've just bought one call on this, happens to be Apple. So I bought the call. That was, so you can see my P&L is, I'm at break even because according to this, I just bought it. And here you have your expiration line, where this is what happens when this call expires. It's going to expire in 35 days, this particular one that I chose. And then you have your T plus 0, time plus 0 line. So this is what's happening today. So if you look at this, here's the price of Apple. It's at 119.02. Now let's say that the price goes to 115. Look at that, 115. So today, if that happened right now, you can see my P&L, I would be down $114. Now, if that happened 35 days from now, I'd be down approximately, look at this number here, $300. So this is the profit or loss. Here's your break-even line here. And then this is the price of your stock. And so you can add multiple options to this, and you'll get different scenarios depending on what trade structure you have on. This happens to be just buying a long call. So so let's say that the price goes to $130. You can see that. Well, if it did that today, I'd be at $510. You can see it right here. Now you can also see what your break even is at expiration. See this expiration line right here where it crosses the break even? Right here, this is the point where you need to get to $130.63 at expiration in order to break even on this trade. So you have a low probability situation when you put this particular trade on because you're buying premium. So think about it like this. The second you buy this, now you need the stock to go all the way up to here to break even at expiration. So you can lose if the stock goes down. You can lose if the stock doesn't go anywhere, it just stays right here. You can lose even if it goes up a little bit. You've got to go all the way up here to 130.63. Now I can look at this 130.63 right here, and I can look at that particular price right now, and I can get a feel for what the odds are of it going there 35 days from now. Looking at the possibilities, if I look at the odds of it going to 130 at expiration, I can see the delta is around 27, which means that it has about a 27% chance of being here or higher at expiration. So you can see when you buy a call or when you buy premium, options premium, you lower your probabilities because your probability to make money here at expiration is only 27%. That means that you've got 63% chance of not making money at expiration. You got a 63% chance that that stock will be less than $130 at expiration. So you can see that buying premium is not a good way to make money in the long run, because your statistical probabilities are that you will lose money. Now next, I will get into mistake number 3, being directional. Trying to pick a stock's direction, in my opinion, is about a 50-50 probability bet. And trying to manage money around a 50% probability is similar to playing blackjack in Las Vegas. It's extremely difficult to consistently make money.
Picking the direction of a stock can be a challenge. Not even Warren Buffett can pick the right direction of a stock. If he could, he would have never been down $3.8 billion on Apple. He would have just waited and bought Apple later at a lower price. There are a lot of gurus out there claiming they can pick the right direction of a stock. I've been around for 26 years and I haven't met anyone that can pick the right direction of a stock and be able to beat the market doing it. If you're out there and you're willing to show your P&L, I'm open to learning how you do it. I highly recommend a book called A Random Walk Down Wall Street by Burton Malkiel. In the book, they tracked 548 stocks that were on the New York Stock Exchange. They applied 32 of the most popular chart patterns in order to pick the direction of the stocks. The performance of the buy and sell signals was compared to the performance of a normal buy and hold strategy. After all the research, there was no relationship found between the signals and subsequent performance.
If you're interested on how to avoid the 14 mistakes that beginner to intermediate options traders make, and how to avoid the 10 mistakes professional options traders make, you can sign up for my free course. There's a link in the description below. Or you can sign up for my 5-step options trading success program. And that course also has a link in the description below.